You might have heard whispers about options trading, how some people use them to make profits, but the whole thing sounds complicated. This video will break down options into pieces, focusing on two main types, calls and puts. By the end, you'll understand the basics and be able to decide if options trading is right for you. So, what are stock options? So stock option contracts are contracts that give you the right, but not the obligation, to buy, which is known as the call option, or sell, which is known as the put option, a specific number of shares of a stock at a specific price, aka strike price, by a specific date, aka expiration date. Think of it like a contract between you and another investor. You pay a premium upfront for this right, and whether the option makes money depends on what the stock price does by the expiration date. Calls are for betting on a stock going up. Let's say you're super bullish on a stock and you're convinced it's about to take off. You should buy a call option. And here's how it works. You pay a premium for a call option. The option lets you buy a certain number of shares, usually in 100 or multiples of 100, depending on how many contracts you want, at a specific strike price by the expiration date. If the stock goes above the strike price by expiration, you can exercise this option and buy the shares at the lower price and then immediately sell them at the higher marketing price, pocketing the difference minus the premium you've paid up front. But if the stock price stays below the strike price by expiration, the option expires worthless and you lose the premium you paid. Puts. This is simply betting on the stock going down. On the other hand, maybe you think the stock is headed for a tumble. You could buy a put option. Here's the flip side. You pay a premium for the put option. The option lets you sell a certain number of shares at a specific strike price by the expiration date, regardless of whether you own the shares right now or not. If the stock price goes below the strike price by expiration, you can exercise the option and sell the shares, even if you don't own them, at the highest strike price, profiting from the difference minus the premium. However, if the stock price stays above the strike price by expiration, the put option expires worthless, and you would lose the premium you've paid. Now, this is a summarized explanation, and options trading can be risky. Options contracts can lose their entire value very quickly, and there are multiple sides to this. You could be the buyer or the seller. There's a lot more to consider, including factors like time decay, volatility, which I'll cover in future videos. The takeaway from this is that you use calls if you think the stock price will increase by the expiration date, and you use puts if you think the stock price will decrease by the expiration date. Remember, this is just a starting point. Options trading requires research and understanding of the risks involved. Before diving in with real money, you should consider paper trading platforms to practice your option strategies. If you enjoyed this video, leave a thumbs up and subscribe for more. Let me know in the comments below what are the stock market topics you'd like to see explained simply, and thanks for watching.